Okay guys, and welcome back to this quick video today. And in this video today I'm going to explain you how I use standard deviation and how you can benefit a lot from it. I would say, since I'm using standard deviation the right way, and this is really specific, my model improved a lot, and since then it changed a lot. Like, I make better profits, and also my losers are smaller and my frequency is a lot lower. So it helps me in a lot of reasons. And so what I'm going to do at first, I have this example here. So this is a bullish example, how you can use standard deviation in a bullish example. And then I have a bearish example on the real chart here. But don't worry, I will explain all this here in a second. But let's start with the bullish example. But at first I want to explain you what is standard deviation. So what we basically do is we use the fib tool, and we have specific numbers here. So you can see we have here the 0 and the 1. This is how we determine the range. And the settings are basically -1, -2, -2.5, -3, and -4. And the most relevant level here is the -4 level. This level, we take a deeper look on it, and we're trying to predict reversals around this level here. But this is about the settings. Now I'm going to explain you how you can adjust this level here. So what we're basically trying to do is, once we have a market structure shift, so you can see here, let's say price was coming up here. Just make this a bit bigger here. And you can see here, okay, this was the last high here that caused this down move here. And we are measuring the range here. So this was the manipulation up that caused this huge down move here. And we are measuring the range here, and then it predicts us future levels. Some people also use these lower numbers here, but I only focus on -4. Because, and this is what statistics say, the -4 level often occurs around reversals if you use it the right way. And what we look for is, we want -4 level should be in alignment with a higher time frame key level. And basically what we do is, you can use it in two different ways. So at first, if you short it from here, you can use it for potential targets here. So -4, this low here could be, so let's say this is a low, a higher time frame key level, this is a old low. You could target this here. But also, if you're not in a position and you have bullish buyers, you could wait for -4 to hit, and you do nothing around here. And you try to find longs around this area here. And this is what I mentioned in the beginning. So I mentioned that my frequency is a lot lower, and it helped me a lot to cut my losses. And this is basically what helped me a lot, because before I was profitable, I was that guy who was trying to long all the way down here. But now I'm waiting for -4. I do nothing here. Like, all the way down here, I wait until we hit -4. So it also helps me a lot when it comes to over trading. But also avoiding a high frequency, because I would say the higher the frequency, the lower is your win rate when it comes to this model here. And and what we are basically trying to do is, I have here a higher time frame picture. So we still say this is a bullish example here. This is also the bullish example, just on the higher time frame. So let's say this is the 1 hour chart and this is the 3-minute chart. Same example here. So we have an uptrend here, and we're looking price to come down, hitting a key level here. And we are just trying to measure, okay, when could this bearish manipulation could be over, and when is the trend continuing. I hope you understand this. You can see this orange zone here is the manipulation zone. And what's also really important is, I would always combine this, for example, with premium discounts. So we are looking for longs, so we are trying to guess, okay, when could this down move be over? And of course, this higher time frame key level and the -4 level should be in a discount. So same for the opposite. So if we are looking for shorts, we want price to be in premium here. And that's basically it. I hope you understand it. If you have any questions, just let me know. And let's move on to the bearish example here. And this was literally this Friday here. And let's move on to a real example. So we had during London this low here. it was created. So I used this one here for, oh, sorry, my mouse is bugging a bit. Yeah, I used this range here for the manipulation range to predict future levels. And you can see here we have -4 level around here. And yeah, this was the range here. It was on the 5-minute chart. And also what we have here, premium discount from the previous day until this low here. And yeah, here you can also see we have, for example, this high here in alignment with -4 almost. I mean, it's still far away, but that's what I'm looking for. We have -4 sitting in the premium area, also really good for shorts. And yeah, the reason in general why I was looking for shorts is we already had this strong sell down here. Yeah, and I was looking basically for continuation. And I mean, in general, I would say London already started to pump really high from here. So when price was trading around here, I was not looking for longs because I look for really large swings. And yeah, just I think the possibility here of looking for longs is really low because London already had a huge range here. And yeah, and same procedure here. I was not trading until we hit -4 level. So all the way up here, a lot of people would already short here. So basic ICT traders, they would, okay, we have Asia high here, we have premium, let's short here. And of course I understand it, and 2 years ago I would do the same. But yeah, I'm waiting until we hit the -4 level with the standard deviation. So you can see I mark this zone here, no trades, because I want to see -4 hit. And yeah, and when the 9:30 open happened, so I marked this out here, 9:30 open, we pumped really high. And this was the last part of the bullish manipulation. We hit -4, and you can see, then we changed. Bearish price moved down. And yeah, now it depends on your entry model, where could be your entry. So I draw out this 5-minute inversion value gap here. This could have been your entry or something on the lower time frame. I don't really care. Now we are talking about standard deviation and not the entry model. But yeah, if you want to learn my entry model on standard deviation, just watch my other videos. And yeah, you can see once we hit -4 and we were in premium, price started to get bearish. And that's simply it. So what we basically do is we want price to reach this level, and then we look for reversal signs. And then we just wait for our entry signal, and then we can enter our trade. And I hope you understand the video. I hope you like it. And like I said, if you have any questions, just let me know. And yeah, see you next time.